of supply chains and M&A deal making. Deborah Gadison Hatter is a partner with Norton Rose Fulbright US LLP. Hi, Deborah.
Hi there.
Thanks for being with me today. We're talking about the findings of your second annual Global M&A or Merger and Acquisition Trends and Risk Report. Based on that, how is government policy today influencing supply chains and spurring deal making?
Bob, that is a great question you ask. And based on our survey results, we have really seen that our respondents, as well as what we've been experiencing, seeing that the Inflation Reduction Act is one of those measures that has had quite a significant impact. As you may know, that act had about $500 billion worth of incentives and spending amounts from the government. And 400 billion of that, I'm sorry, is directed at clean energy. And so, as you can imagine, investments, loan guarantees, grants, tax incentives, that is quite a large pot of money that is spurring deal making, because companies are literally incentivized to go out and invest in clean energy projects, clean transportation. We're seeing lots of interest in hydrogen. Clean transportation is EVs, all sorts of areas. And of course, all of those items include supply chain elements, right? So if you are building new EVs, then that means there's a whole host of products that go into those vehicles, as well as the infrastructure aspects. So that act alone has spurred quite a bit of deal making, and our groups that are focused on renewables and all things energy have been quite busy in addition to other areas.
Define for me, Deborah, what is vertical deal making, especially from a supply chain perspective, and what impact will it have on government and shareholder scrutiny of these potential deals?
Another great question. Vertical deal making is really where you look at, instead of combining equals, it's really combining one company in the supply chain. So maybe you used to do a lot of work, you're a large corporate, and you have suppliers of products who you are obtaining your supply from. And so instead of having that third party relationship, you acquire the supplier. And then that means that you no longer have you are able to realize some of the synergies by owning it and having it within your network, instead of having a third party relationship and maybe eliminating some of the markup that you would have had, and also having to share that supplier with others.
Does that raise bells or warning flags for government
It does,
regulators?
absolutely. And especially from the competition standpoint, because you may be eliminating that supplier for others to be able to use them. And in fact, even if you do continue to allow them to sell to third parties, you are maybe more likely to increase pricing. And again, one of the concerns that regulators always have is, what does this do to the consumer? Will the consumer end up having to pay higher prices or have fewer options going forward? So that definitely raises bells, all sorts of bells for regulators, and particularly in the competition world. And that's not just in the US, that's globally. And as we have seen, the world is so much smaller now that many products are not just sourced domestically, they're sourced globally. And so there are global concerns with that.
And yet, do you believe that larger companies will continue to pursue these deals anyway, notwithstanding these concerns that might arise?
Absolutely. Because of the incredible concerns and challenges that large corporates have had, particularly stemming from COVID and going forward from that, we've seen all sorts of scarcity in products. And you're often hearing, just as an individual consumer, about how there are delays on either whether it's a new vehicle or whether it is grocery store items, whether it's, diapers, whatever it is, right? There's something that is in scarcity in terms of supply. And often the answer is the reason is that there are products that the corporates are not able to source. And so if you then own the source, you no longer have as many concerns about being able to produce your products.
This seems to be a complete reversal of the trend of recent decades in which manufacturers break up the pieces and rely on a whole multi-tier universe of suppliers to provide them with that. And now it seems to be consolidating again. That's very interesting. I get the feeling from your report, though, overall, that you're pretty optimistic for M&A deal activity in 2024. Is that indeed the case? And if so, what is driving that activity and what's causing you to be optimistic about it?
That's right. The survey results were pretty broadly optimistic, and that's on a global front. And I think we're still cautiously optimistic because there are a number of variables hanging out there that could change this at any point in time. But generally, we think that the market is starting to sort of settle into, at least in the US, higher interest rate environment. Um, Debt sources are becoming more and more available. And one of the issues we had was that maybe there was a valuation gap, right? A huge valuation gap between buyers and sellers. And we're now starting to see that closing. Maybe it's because there are sellers who are a little bit more willing to accept the prices that buyers are willing to pay. There are also a lot of tools that are being used to try and bridge those valuation gaps in terms of earnouts or even seller notes, things like that, that are helping.
You note an increase in availability of private credit. What is the significance of that, and why are we seeing that as opposed to bank credit, bank loans?
Right, because of some of the lending requirements becoming much stricter, private credit has really stepped in to fill the gap. And so with the advent of increased private credit out there, which is really being filled by private equity type funds who are lending, there has been an increase in availability of capital. And so with that increase in capital, the deals are able to be done. They're more expensive, but now the market is settling into understanding what that means, and it's being priced in. And so deals are happening.
Higher interest rates are being priced in, you're saying, that they're
That's
not an
right.
obstacle. They don't create a hurdle to be overcome or challenge the proliferation of these deals. Is that what you're saying?
That's right. That's right. Over time, people settle into realizing that we were in a very low interest rate environment
Mm,
for a very long time. And so you begin to realize business must go forward.
yeah.
Growth will continue. And so as you begin to wrap your minds around how this can continue to work, how you can still generate returns, and even with higher interest rates, and then you move forward. And that's what we're seeing. You also
Especially,
see
go on,
deals
I'm sorry.
being made, sorry.
No, no,
You
go
also
ahead.
see deals being made with cash on the books. So you have a lot of large corporates out there who maybe don't even have to borrow. And so they're using their cash and they're able to get in there and compete in a way that they maybe weren't able to compete because they were being priced out.
Still sitting on cash. How interesting after all these years. Okay, so though, however, given the proliferation, continued occurrence of supply chain disruptions, whether it's in the Red Sea, whether it's in the Panama Canal, or whether it's pandemic caused or whatever, do you see that as a possible obstacle to future M&A deals? Or what other types of potential obstacles might arise that would tend to kind of temper your optimism in 2024?
So one of the big factors we touched on some of the government regulation is spurring deal making. There are also some that's also cited in the survey as being one of the largest hurdles.
Double-edged
So
sword, as they say. Yeah.
exactly, exactly. So particularly with respect to some of our foreign investment requirements, and not just in the US, but also around the world, you're seeing um, increased scrutiny by government regulators, and there are new rules around requiring advanced filings before acquisitions from non-domestic parties can go forward. And that has, you know, understandably created some uncertainty. And buyers and sellers never like to have uncertainty and have third
Mhm.
parties in control of their transactions. So that is one headwind as well. So the foreign investment regimes, but also the competition concerns, as we mentioned, We still think, parties will push through that, but those are a couple of things along with the availability of credit and the interest rates being higher, some of those items that will slow a bit of deal making.
Going to be an interesting year. Deborah Hatter of Norton Rose Fulbright, thank you so much for helping us understand what the coming year might look like in terms of M&A and supply chain deal making. Really appreciate it. Thanks for your time.
Thank you.